So just to give you a bit of kind of background about me, I'm actually a former landlord. So myself and a business partner, we were kind of buying and selling mixed-use buildings, and we were kind of doing something you do in Canada, condoization. So we were selling off the residential units. We started collecting all these kind of orphan commercial properties by accident. So we kind of fell into flex leasing because we didn't know what to do with the properties. We were having trouble leasing them traditionally. And what we found is we actually got quite good at it. We kind of built this flex leasing platform. We were able to increase our properties NOI by 40%. So 40% more profitable, not just revenue, but more profitable. And we thought, oh, this is great. We're gonna we can buy buildings, increase the profitability, get them revalued, go borrow some more money, and go buy some more, and just kind of rinse and repeat. And of course, we ran into the same problem everybody's running into. Valuations didn't move, and the lending actually got worse. So our worst loan was an 8.5-year amortization on 2 commercial buildings. So you're talking kind of car loan territory. And I just couldn't figure out why. And I thought, well, we're in a tertiary market in Canada. I thought this has got to be some kind of local issue. So we kind of started running a series of experiments, getting appraisers or valuers from outside of our market. And the answer always came back the same. At the time, I was doing my dissertation at the University of Reading. And it was kind of a flexible program. I'd come over for a week and then do the assignment over the next couple months. Talking to people there, I realized this is a global problem. So I thought, okay, I'm going to tackle this as my dissertation topic. And kind of out of that topic and kind of the discussions that I've been having with people over the last few years, I've co-founded ReturnSuite, which is a software product that's designed to kind of model kind of more complex cash flows. So I've actually kind of sold the real estate company, and now I'm somehow ended up in the software industry. What I've come to realize, or my conclusion is really the office market is really this kind of lost world, that the long-term lease and the stability that comes from the long-term lease has kind of created this kind of specialized ecosystem, allowed this ecosystem to evolve of kind of lenders and investors, valuers, landlords, and even regulators. And it's kind of untouched by kind of what we would all consider kind of the normal world where there's a lot more volatility and variability. And kind of what we're seeing now is kind of almost like kind of a first contact type moment where tenants and customers are starting to demand more flexibility, and they're actually willing to pay a premium for it. But for kind of artificial reasons, the supply side can't provide this flexibility. And so we're kind of at risk of having these stranded assets, and it's for an artificial reason. Like these properties aren't kind of impaired in any way physically. It's just that we can't seem to figure out how to value them and finance them. And so we have this kind of really strange mismatch. And what's, I guess, good news is this is really a solved issue. Tons of different industries deal with much more variable and volatile income than office real estate. And essentially what we need to do is we need to kind of figure out a way to incorporate this flexible income into our valuation methods. And what that means is we're going to need new sources of data, and we're going to kind of need new software tools to do this. So when I just kind of give people a warning, I'm going to start going through kind of like technically how you value and different valuation methods. So if you're kind of sitting there thinking, okay, why do I care? Basically what I'm trying to do is get everybody kind of speaking the same language. I kind of see it almost like a game of telephone where you have kind of service providers and flex operators on one side, and they're using terms like customer acquisition cost and community. And on the other side, you have the lenders, investors, and the capital markets, and they're thinking about risk-adjusted returns. And if we can kind of get everybody kind of speaking the same language, I think, we'll all be able to kind of start thinking about what the other stakeholders care about. And I think, so if you're a service provider or an operator, even if you're leasing off your landlord, understanding that your landlord is actually pretty worried about what their lender thinks is going to be a useful tool for you. So when I started looking at this, the valuation question, I did basically I tried to take a first principles approach and kind of ignore the fact that we're kind of talking about real estate and just go, okay, how can we value any asset or even liability that has more kind of volatile or variable income? And so really what I did was I went back into like a kind of accounting rules. How do you define valuation? And both the group that does US GAAP and the group that does IFRS have essentially the same definition of what market value is. And it's the price an asset sells for in an orderly transaction. So basically, nobody's under duress. It's been on the market for a while. There's enough potential purchasers out there. And so, in this kind of, perfect scenario, you would get a transaction. And that would be the market price. But there's really kind of two types of valuations. The first one is an investment valuation, or what we would all think of as underwriting. And so that's the value to an individual investor. So every individual investor has got a kind of different tax situation, timeline, strategic goals, costs of capital. So they're going to kind of come up with their own underwriting, their own investment valuation. And you get a whole bunch of potential purchasers to do that, and likely the one that comes up with the highest number will be able to strike a deal with the seller. What the market valuation is, or kind of in North America what we would call an appraisal, that's a guess at what the investment valuation is. And so this is really important. The valuer's job is to try to guess what investors are willing to do. So valuers can never get ahead of what investors are doing. So if investors started kind of paying more money for properties with kind of better environmental standards, or even like just completely random things. There's more glass or less glass, more concrete. I love brutalism, whatever it is. Once those transactions start happening, market valuations then have to start incorporating those. So basically there's this whole family tree of valuation methods, and in real estate and especially in office, we're really stuck with the standard capitalization model. But there are kind of 4 other ones that include flex. So what I'm going to do is go through each of the valuation methods with a really simple sample property. So basically, standard capitalization, if I was to generalize it as a rule, it'd be just ignore flexible income. So we're going to have this, our fictitious property here. It's 100,000 square feet, half of which is leased traditionally for £50 a square foot, and half at £75 a square foot, and that's leased flexibly. We're going to kind of ignore expenses. So this is all profit. This is all going to the net operating income of the property. So under the standard capitalization model, even though half of it is leased flexibly and is earning more money, you just ignore that and pretend the whole thing leased for £50 a square foot. So that gives us a net operating income of £5 million. Then what you do is you look at the market and you see what transactions have happened on the market. You find similar buildings that have sold in the last, depending on how active your market is, maybe the last 6 months, maybe the last couple years. And you see what return those properties were making. And so let's say in our example, we look around, we find some transactions, and we find that the capitalization is 8%. So we take the £5 million, which is a 1-year snapshot, we divide by 8%, and that gives us a total value of £62.5 million. Actually, if you want to get into weird online arguments, you can, which I did by accident, you can start asking people, why can't we include flexible income? And the argument is that by including flexible income, you're mixing business and real estate value. And in a way that makes sense. So for example, if you were kind of leasing to Microsoft, it doesn't make sense to kind of, I'm going to value the lease plus I get a percentage share of their business, right? Like that's kind of the argument that they're making. But this isn't, we're not talking about kind of trying to claim part of a business's income here. So again, if we kind of dig into like the valuation rules that accountants have set up, they have this term called highest and best use, which basically says that regardless of how a property is being used, you should consider its most economic or profitable use when you're trying to come up with a valuation. And within that definition, they say complementary use of other assets can be considered as long as they're available to other market participants. So say 15 years ago, it did make sense to say, if you had a flexible leasing platform, and that it's just not available to everybody, right? There isn't a lot of flexible leasing platforms back then. But now, if you're a landlord and for whatever reason your operator goes under, hands back the keys, you're going to have a lineup of people, operators, that are willing to take over that space. So I would argue that we can consider flex because there is a ton of market participants, right? And this, therefore, it should be considered part of the highest and best use, and then which means that flexible income should be included in our valuations. So if we kind of accept that premise, we basically have kind of 4 potential options in this kind of large family of valuation methods. So the first 2 I'm going to go through are the direct capitalization methods. So they're really closely related to standard capitalization. And basically, they're all taking 1-year snapshots. So typically, you're just looking at either the current year that just happened or the future year. Tiered capitalization, basically it's the sum of the parts. And when you're talking about the sum of the parts, it's like the physical spaces. So kind of using our same sample property, we can break it up into essentially 2 half buildings. And we have our traditional space, it's 50,000 square feet at 50 pounds per square foot. So that gives us an NOI of 2.5 million pounds. We can use the same transaction data. So, we can look around, cap rate's 8%. So 2.5 million divided by 8% gives us 31.3 million pounds. So that's the value of the traditional portion. And then we look at the other 50,000 square feet that's earning 75 pounds per square foot. So that gives us a much higher NOI, so 3.75 million. But we run into our first problem, is where do we find this cap rate? So we would need to look around the market and see transactions where an entirely flexible property just sold. And we'd need to know how much money that was making, what it sold for, and then we could kind of figure out the cap rate. But of course, we don't have 100% flex properties that are selling. Even in really active markets, like say London or New York, that's relatively rare. And then when you start getting into kind of secondary markets, it basically doesn't happen. So we have this issue. Where do we get this 12.5% cap rate? I think it's really, really hard to do. But let's pretend that we can find that number. So we're able to find comparable sales. We have 12%, so we divide the 3.75 million by the 12.5% cap rate, and we get a valuation of 30 million. Now we combine these 2 numbers together for a total value of 61.3 million. So the next method, which is closely related, again, it's a kind of 1-year snapshot. It's called the top slice method. I came across this one. This is that Savills was doing this. And so it's the sum of the parts, but what we're going to do is instead of physically dividing the space, we're going to look at the different kind of cash flows. So you kind of have our normal income and then our excess income. And so we'll kind of start with the bottom slice. So it's exactly like the standard capitalization. We're going to pretend it's fully leased normally, 100,000 square feet, earning 50 pounds a square foot, 5 million in NOI. Again, we can find comparable sales on the market. So we have our 8% cap rate, and it gives us the 62.5 million, which is the exact same as the standard capitalization. But then what we do is now we're going to add the flexible income. So that kind of premium 25 pounds per square foot multiplied by the 50,000 square feet that's being leased traditionally. That gives us an extra 1.25 million pounds. But we run into the same issue. Now what we're looking for is we're looking for a sale in the market where somebody sold just the premium income from their property, which is, it's going to be pretty hard to imagine this happening. Maybe there'd be some ways where we could back out what it is if we see an actual operator trade and we understand exactly what their profit is. So there might be some kind of like roundabout indirect ways to do this. But I think it's, again, a major problem. Where do we get this cap rate? So we'll kind of suspend disbelief, pretend we can find it. And let's say it's 16%. So we divide 1.25 million by 16%, and we get a valuation of 7.8 million. We add these two numbers together and we get a total value of 70.3. So if we were to kind of compare these methods under a few different factors, basically, standard capitalization doesn't include flex income. So it doesn't really fit the bill, not what we're looking for, where the other two models do. And then there's this kind of question, does it really reflect reality? We know standard capitalization doesn't, because it doesn't include the flex income. The tiered capitalization, while it kind of looks like it makes sense on the surface, you'll notice that the valuation actually went down on the top number. And there's this issue where kind of your ratio between your cap rate and the extra income you're making, if that is at all off, your property becomes worth less despite it making more money. And if you were to kind of apply that to, say, to the hotel industry as kind of a sense check, that's like saying kind of Ed's drive-in motel with no services is worth more than a Ritz-Carlton or a Four Seasons hotel. So it doesn't really kind of make a lot of sense. It doesn't reflect the reality. And then we kind of discuss kind of the comps or the data issue, like where do we get these cap rates? Standard capitalization, easy to find, but we start running to issues when we're talking about the tiered or top slice method. We can't quite find all the data. But the good news is these are all relatively easy to do. You could do this with a spreadsheet, assuming you have the right data. So there's kind of two other methods that kind of fit the bill, and they're both present value methods. And basically, rather than just looking at a one-year snapshot, they look at kind of multiple years of operating. What you do is, so we have today's property, like we're trying to figure out the value of the property today, and we know there's going to be this series of cash flows, profitability that comes from the building, and then we're going to sell the building at the end. And so we want to discount all these future cash flows to today's value. So if we want to do that for our sample building, we need a few more pieces of assumptions or information. So for the stream of NOI, we know they're going to grow each year, so we can tack on a growth rate. So let's say 2% a year. And we're going to, arbitrarily say we're going to hold on to this property for 10 years. Now we have to figure out, okay, what discount rate are we going to use for each of these income streams? Well, we can use, say, 10% for traditional, but we kind of run into the same problem with the flex income. What's our comparable rate? Like, what's our cost of capital? What kind of return should people expect on this more variable income? And we don't really have that information. We'd have to be able to kind of try to figure that out. So we'd need transaction data again. So it's kind of the same problem. But let's say we could figure that out. So we 10% on our traditional, 18% on our flex income. That gives us a valuation of £39.1 million for that kind of stream of NOI. But of course we have this future sale, and we've kind of kicked the problem down the road. We still need to come up with a valuation for this future sale. So what valuation method do we use? Well, let's say we're going to use the top slice method because it seems to be kind of the best in class of the direct capitalization methods. We're going to use a discount rate of 10%. For that cash flow in 10 years, we discount that back. That gives us a value of $29.8 million. We add these two numbers together, and there's our valuation. So kind of everything that we've done so far to account for risk, we've been tweaking either the discount rate or the capitalization rate. But that isn't where the risk is. The risk is actually in the cash flows. That's where the variability is. And so we can kind of undergo this paradigm shift by starting to model the risk where it actually resides in the cash flows. The question is kind of how do you do this? And that's where you come across kind of expected value methods. And you can kind of think of this as kind of best case, worst case scenarios on steroids. And how it works is rather than using kind of an individual input, 75 pounds per square foot, you're going to use a range. And so in this case, it could be anywhere between 57 and 93 pounds per square foot. This is for the flex income next year. And what we're going to do is we're going to randomly draw a number out of there. Most likely it's going to be somewhere in the middle, near 75 pounds a square foot, but there is a probability it could be on one of the extreme tails. And we're gonna kind of draw a number and run the model, and draw the number again and run the model again. We're gonna do this thousands or even tens of thousands of times. And what happens is we start to get kind of like we get a ton of different results, and we start to get a sense of like kind of the potential range of outcomes. And this is something that's really, really common in other industries. This is what the mining industry does. This is what most areas of finance do. The insurance industry, pharmaceutical industry, anywhere where there's a lot of unpredictability or variability around income, this is the modeling that they do. And so you might hear this referred to as kind of Monte Carlo sampling or Monte Carlo analysis. That's what I'm describing here. So how this would work for our flex property is, so again, we'd say, okay, well, both NOI, streams of NOI are going to grow at 2% a year. But what we want to do is kind of figure out, okay, what's our range of potential inputs on each of these? So we can say, well, let's say traditional is going to be kind of 4% volatility, and on the flex, we're going to double that to 8%. So the flex is going to jump around a lot more. We can use this standard capitalization method for our future sale, because we have all the data for that. And we can discount everything back at 10%. We no longer need to figure out different discount rates because we've already modeled the risk in the cash flow. So we don't want to double count the risk by then doing a different discount rate. So if we were to do all that, we would get a value of 70.8 million pounds. But there's a lot of extra information that comes out of this. So because we're going to have 10,000, 20,000 different results of this model, we can kind of bucket them and create a histogram, and we start to get a sense of the range of potential outcomes and the likelihood. And so here, when we talk about 70.8 million pounds being the value, that's the weighted average of all the model runs. But we can see kind of the potential, like it could go quite high, and we have some lower ones here. And what we can start doing is go, okay, well, what's a good cutoff? If you're an investor, you say, well, I want to make sure that it's worth at least what it is worth under the standard capitalization model, which was 72.5. And what we find is that that's at the 5 percentile. So 19 times out of 20, it's going to be worth more than what we originally thought it was under the standard capitalization model. So it kind of gives us a lot more information. And I think this gives investors and lenders a lot more information. So they start to see the shape of the risk. And so maybe a lender goes, well, okay, well, in the worst 5% scenario, it's worth 62.5 million. I'm willing to lend, what did I put in there, 42, almost 43 million pounds against that, because I'm certain it's going to be above water, even in some of the worst case scenarios. And then because we're modeling the risk in the cash flows and not the valuation, we actually have a lot more data on the cash flows as well. So here we have a graph of kind of the actual cash flows from the property, and you can see kind of the range of potential future cash flows. So this is the NOI from the property. So the kind of, it's a little bit hard to see, the gray line there is kind of our expected case, and the orange yellow line there is our 5 percentile case, so our worst case scenario. And if we were to borrow about 43 million pounds over 15 years, we can see like kind of what the debt service cost would be. And the bank's going to have some kind of coverage ratio, and that's what the second line is there. And we can see even the worst case scenario, the cash flows just kind of come down and just touch the coverage ratio line. So this is the kind of information I think banks and investors want to see. It gives them kind of more confidence as opposed to just seeing something that's the same value, but it seems riskier. It doesn't seem like a good trade for them. If, great, you lease flexibly, you make more money, it doesn't change how much the bank makes, right? So kind of providing this kind of information, I think, will help. So if we were kind of to compare these final methods, so we got kind of the top slice, which is kind of best in class, versus discounted cash flow expected value. We can see actually the valuations actually come out really similar. They all include flex income, so perfect. Does it reflect reality? Top slice, it's pretty good, except for it only uses 1 year's income, and it doesn't really give us a lot of information on the cash flows. Discounted cash flow multiple years, but again, not a lot of information on kind of the potential range of cash flows, where the expected value method does kind of show a lot more. In terms of comps or data, like this kind of market or transaction data, hard to get in the top slice method, even harder in the discounted cash flow, because now you need both a discount rate and cap rate on the flex side. And the expected value method, it's really, we're looking for a completely different set of data. And I'm going to kind of get into that in a bit in a moment. And then the other issue is, is this easy to do? Top slice, yeah, it's quite easy. You could use spreadsheet. You could do this discounted cash flow. Again, you could use a spreadsheet. It's going to take you a little while, depending on kind of how good you are at spreadsheets. And the expected value method, really you've kind of moved beyond what spreadsheets can do. You're going to need some kind of add-ons or kind of specialty kind of statistical software. So this is one of the issues why I think real estate's had a hard time switching to the expected value method. But I think, essentially, as real estate gets more operational, we're moving to this more equity-like world. And it's just more complicated. It's just the way it is. So it makes sense that our models have to get more complicated and sophisticated. And I believe kind of as investors adjust, the investment valuations change, the market valuations will have to follow suit. So I think we're kind of moving from a world where revenues are predicted by leases, right? You can go look at the lease, see what the terms are, and kind of model out the revenues that way. The transaction data is key. You want to know what properties are selling for, what the leases are for. This is kind of the key information in this kind of old world. And spreadsheets are the kind of the main tool for these cash flows, modeling these cash flows. And we're going to be moving to a world where kind of the revenues are actually predicted by kind of past performance. So operating data becomes key. And as a result, we're going to need kind of custom cash flow modeling tools. And this is basically kind of the thesis behind what we're developing at ReturnSuite is that, these new cash flow modeling tools, whichever one you were to use, they need to be easy to use and they need to be transparent. It can't be some kind of black box. You put in information, you don't really understand what's happening. It's kind of doing something kind of complex and statistical behind the scenes. Like that's not going to help anybody because everyone kind of needs to understand and kind of have a feel of what the risk is. But at the end of the day, it has to be powered by good data. Because like any calculator, if you put in really goofy numbers, you're just going to get goofy results. New sources of data, I think, is really important. That's why I'm kind of excited about the group of people that have come out, because this new data isn't held by the same people. And this is, I think, another one of the reasons why we're having a hard time switching. Valuers currently have transaction data, so that you kind of, to a carpenter, every problem requires a hammer, that type of thing, where what we need to do is start looking at these different sources of data. And I think between us all, we're sitting on them. So I think landlords and operators, you have data on kind of like the actual kind of licensable square feet you're operating, kind of what the historical revenues are, and really understanding the kind of what I call departmental costs, or like the specific costs related to running flex, and how they're related to, say, occupancy and revenue. Kind of this type of information I think landlords and operators are sitting on. And service providers, they're going to have so service providers, say, like maybe an operating platform or booking software, or people that are kind of helping operators kind of extract data out of those systems. Really kind of what is the revenue range? That's what we need to know, is understand, like, that 75 pounds per square foot, how high could it be and how low can it be, and what's that probability? So service providers are going to have that information, or be able to help operators draw out that information, and as well kind of help predict expected growth rates. And then data providers as well, what we're looking at is kind of different benchmarks, not kind of the traditional, well, this is what properties are selling for, or this is what the lease rate is. But there's a lot more variability even within operators, and so you kind of, here's a benchmark, here's what we're expecting, and this is why we think we can get a 17% premium, or so that the benchmark data is really key. And again, trying to kind of predict kind of market growth. So kind of in conclusion, basically valuations aren't coming to save us, because valuers can't get ahead of how we're underwriting this stuff. So that's kind of bad news, but the good news is it's actually within our control, because we're the ones that are underwriting this. And really, if we kind of combine the domain expertise of the operators and landlords with kind of the service providers, we get the right operating data and we're able to put it into the right modeling tools. I think this is a solved problem, or I think it's already a solved problem. We just need to actually kind of collaborate together to solve it. I always love talking about this. It's probably obvious. So if anybody wants to chat with me after, you can always reach out to me, send me an email, and I'll talk for hours about this stuff. So
you will. I've got lots of voicemails.